Do financial advisors and publications like Morningstar and Kiplinger and Forbes, do they know about reverse mortgages and do they understand about reverse mortgages? Well, what I have today for you is an article that was just posted in Morningstar yesterday, where they do go over. They spend quite an amount of time in this article talking about reverse mortgages, and they get some stuff right and they get some stuff wrong, but we're going to review it together. I'm going to share the article with you, and you're going to see if you agree with their take on reverses. So let me share my screen right here. Okay, cool. So it's right here. This is the article. It's on Morningstar.com. And Morningstar, again, it's like Forbes or Kiplinger. They sell subscription services. Obviously, they've got lots of ads, and they're an article for folks who are looking at investment advice for the most part. What I'm going to do is we'll go through this article right here. They talk about reverse mortgages a little bit, and to their credit, actually, because for the longest time, financial advisors, even CFPs, certified financial planners, they were not allowed to discuss home equity when it comes to a retirement plan. They were banned. They're compliant. If they talk about it, they could get fined, they could get fired, and it all came from their compliance departments. So now we see kind of a shift over the past few years, whereas, and if you think about it, it makes sense. If you're really discussing the entire picture, or the entire pie, if you will, of somebody's finances for retirement, you've got to talk about their insurance. You got to talk about their savings, their checking, their expenses, their 401ks and their investments. What's that? 6 things. And finally, now they're starting to talk about home equity. And I feel like, and I'm biased, but I also have a special window from doing reverses since 2008, that home equity is so important to discuss as a way to live as long as you live a little bit better, as long as you can live financially comfortable. So who am I real quick? Just introduce myself. My name is Jason Eichmiller. This is my website, reversequotes.com. If you want to reach me to see if you qualify for a reverse or if you have any questions about it, you can always reach me at 888-309-9705. You can put your information in here. If you're going to reverse quotes on desktop, it's over on the right. And if you're going on your laptop, it's below. This little form submit is below. And then here, if you want to look at what other seniors have to say about reverse mortgages, how they feel after they did a reverse, then go ahead and just scroll down, and I've got a bunch of testimonials and videos and all that fun stuff. So that's how to reach me. Now let's look at this article here. So again, go to Morningstar.com, or actually, if even easier, is if you just type in Morningstar into Google and you type in reverse mortgage, then you'll find it. So first of all, 2 ways to use home equity to fund retirement. We're actually going to talk about a third way. So we're going to do 1, 2, 3 ways to use home equity to fund retirement. Yes, a reverse is one of them. Tapping home equity gets a bad rap as a retirement planning strategy, but it shouldn't. That's different. Again, back in the day, based on dated information, major firm compliance departments weren't letting their financial advisors talk about home equity. So now they are. Now, this is by a guy named Mark Miller. Who is Mark Miller? Let's go down and see. He doesn't get everything right, by the way, I'll just tell you. Mark Miller is a freelance writer. The opinions expressed are the authors and the authors alone. So I don't expect Mark to get everything right, but I just think, again, I think it's neat that he's discussing this stuff. So let's see what he says. What does Mark say about how to use home equity to fund retirement? Now, mention the idea of tapping home equity to fund retirement, and people automatically think that you're suggesting a reverse mortgage. It's one of the best ways to tap home equity for retirement, but it's only one option, and people should explore other ways to extract value. Now, why do you need to talk about home equity in retirement? Well, if you think about where home values are versus investments versus inflation, home values are either at all-time highs in some areas, or they're close to all-time highs. Maybe they've dropped a little bit from when the rates were 3%. So a lot of folks, especially seniors who've owned their homes for a while, they either don't owe much on a mortgage or don't have a mortgage at all. So they have all this equity, all this money that's trapped inside of their house. But it's hard to get it. It's one thing to say, let's say your house is worth $800,000 and you have a $200,000 mortgage. Your equity is $600,000. So it's just your value minus what you owe on it. So you got $600,000 of equity. So how would you use it? But before we talk about how you use it, we got to address why you would use it. Because in a perfect world, if your income was high enough and your expenses were low enough and you had enough of a retirement safety net, you wouldn't need your home equity. Let it sit. Let it just do nothing. I mean, it seems inefficient to me. Excuse me, grabbed a drink. It seems inefficient to me because you want everything working for you, and sometimes when you use your home equity along with your investments or insurance or annuities, then it can even work better. But if you don't need it, you don't need it. The problem is in this economy, and you can probably explain to me just as well or better than I can explain to you, is that yes, our home values are high, but also our investments have dropped tremendously. It's just a fact, they have. I'm sure there's a few that if you take a look at an exact stock, there's a couple maybe that have run up over the past couple of years, but I couldn't name what they are. So our investments have dropped. And then what's inflation doing? Well, yin to the yang, Social Security has gone up. It increased at about 8% or so last year. That's a pretty big annual increase, but it increased at 8% and it couldn't even keep pace. It couldn't even keep pace with gas, with milk, with groceries, with all of our other expenses. And if you're a senior and you're on fixed income, your senior living expenses, they've gone up, and the increase in those expenses has way outpaced your Social Security. So you're getting squeezed in two areas. Again, your home equity is good. It's awesome. Higher than ever or close to as high as ever. But you're getting squeezed in your cash flow, meaning that everything's more expensive and you're bringing home less money. And you're also getting squeezed with your savings and with your investments. Because if you have investments, they're down. And if you have to take more of it out, more of your, let's say your 401k out to pay for your higher living expenses, well, then your investments are down and then they're getting drained, which is kind of a double whammy. And then if they're getting taxed, you've got down investments, you're taking too much out of them to sustain, and it's getting taxed. It stinks. And that is why, at least in this day and age, seniors are taking, or they're trying to take, the home equity out of their house. They want to take their equity so that they can survive, so that they can live, so that they can thrive, and their cash flow is improved, and the retirement safety net is improved. So anyway, that is the reason why. Now the question is, how do you take out of your home equity? So there's three main ways that you can do it. Number one is selling your home. Number two is getting a good old regular reverse mortgage. And number three is, yes, getting a reverse mortgage. Let's see what they have to say right here. So the role of housing wealth in managing longevity risk. Yeah, that's what we just talked about. Homes are stores of wealth that aren't necessarily as liquid as other assets, but it's important to understand the role because they can provide some liquidity protection, says a guy at Vanguard. So housing wealth can be a good option for funding long-term care expenses. Okay, we understand that you got to use, in this market, a lot of folks need to use their home equity. But again, how do you use it? Number one, you can sell your home. Now, again, let's look at somebody with a $800,000 house who owes $200,000. I get folks like that all the time who reach out to me. Should I stay or should I go? My first question is, money aside, what do you want to do? If money wasn't an issue, would you stay? Or do you need to downsize? Is your house 2 stories and you need to get to a rancher? Do you want to move near your kids? Do you want to move to a 55 and older where you don't have to cut the grass? Do you love your home so much? You have so many memories there, you couldn't ever imagine leaving. So that's the first thing. What do you want to do? But let's say you want to sell the house. So put the house on the market and sell it, and you get a big chunk of change. Let's see if $800,000 house, 200 is owed. Let's say you get $550 out of it because you got to pay realtor costs and transfer taxes and all that other nonsense. So you get $550 out of it. And you're like, wow, I got so much out of my house. This is terrific. But what's happened? When you go to look to buy another house, that other house has appreciated just like your house has appreciated. So now you got, I'd say, overpaid for your home, or it feels like it, but now you have to overpay for the next house. And now you're at a higher mortgage rate. Or maybe you're downsizing and you're paying cash, and that's all the cash that you have. Because most people, when they downsize, they still want a nice place, right? So a lot of times it doesn't make sense to buy a home with a mortgage. On the other hand, maybe your kids have an in-law suite. Maybe you can move in with them. It's an option. Certainly something to discuss. I don't, as much as it is an option, I don't see it happening that much because, truth be told, psychologically, adult kids have their own families, and it's kind of tough to have their parents now live with them 24/7 forever. And vice versa. It's pretty uncomfortable for the adult parents as well. And so that's an option. It could work, but it's unlikely. And the third option is rent. Sell your house and rent somewhere. The problem with rent, though, and it obviously depends on the area, but rent, in a lot of cases, rent is just as expensive or more expensive than a mortgage. So it's going to take that money. You got $500,000, but you're paying $4,000 a month in rent or $5,000 in rent. That goes pretty quickly. That's less than 10 years. That's very, very concerning. Do you expect to live longer than 10 years or less than 10 years? So while saying you want to sell your house is one thing, actually selling your house and finding the right place to move to is another. Just went through this exercise with a fella in my state, in Florida, a couple of days ago, actually. He's considering staying, considering going. He doesn't really know what he wants to do. So, or he isn't clear on it. And so we went through this exercise. Okay, if you're going to sell, where are you going to go? The other thing with staying in your house, maybe you love it, maybe you have memories, maybe that's where your community is. Maybe you really want to be there, but you want to use some of that equity that you built in, and you need to use it and turn it into cash. So, all right, this is done with the house selling. Again, works in some cases. Once you really look at the numbers and you look at your feelings, it makes more sense to stay in the house. So the second thing, borrow against it. So you have two options when you borrow against your home. Number one is to do a regular mortgage, and number two is to do a reverse mortgage. So it even says here, conventional mortgages and home equity lines of credit are one possibility. But, and here's the thing, the amounts that you borrow, I'm going to highlight this, the amounts that you borrow must be repaid with monthly mortgage payments. So if you're retired or you want to be retired, eventually you don't want to work. I mean, that's the dream. You don't want to work till you're dead. Some people want to work till they're dead, but not me. Not the people that I know. So if you get a mortgage, if you can qualify, because they will look at your income, but let's say you're still working, but you know you're going to retire. You get a 30-year mortgage. What happens when you retire? Are you going to be able to afford that mortgage? That's a tough question to ask. You got to look and see where your money's coming from. How are you going to make money in retirement? Social Security, a pension, investments, annuity? What do you have to back you up? And once you retire, again, will you be able to afford that additional mortgage payment along with your property taxes and homeowners insurance and Medicare supplement and gas for your car and groceries and electric bill and gas bill? You get it, right? Oftentimes, not all the time. I've actually had people call me for reverses, and we've chatted and we've dug deep into their situations, and we've ended up helping them with a regular mortgage instead of a reverse. But that's few and far between. When it comes to cash flow, the majority of seniors, even ones with over $1 million in assets in the bank, the majority of seniors do not want to take another debt where they have to pay month after month after month, and they're negatively impacted, or their cash flow is negatively impacted. So, yes, getting a mortgage is a possibility, but it's kind of a fringe one. So, as they say in the article, as our guy, what's his name? Mark, I thought his name was Mike for a second. As Mark says, that brings us to a reverse mortgage. So reverses. So now he starts going over what a reverse mortgage is. Most of these loans, this is right, the HECM, or the home equity conversion mortgage, is the federally insured reverse mortgage. Most of the deals, excuse me, most of the folks that I work with and I help, most of them choose the HECM. There is a small percentage that chooses a proprietary reverse mortgage. Now, this is not the video where we're going to go through the differences between the HECM and the proprietary in depth, but at a high enough level, just so you understand, the HECM, it is government insured. It is non-recourse, meaning that if you owe too much and the property drops, then nobody can say, we want our money back. And if you owe too much and you pass away, your kids aren't responsible for the difference. Same thing with the proprietaries, though. So the proprietaries they're kind of self-insured through the lender. And it's required. Every single reverse mortgage on the market, at least now, is non-recourse. So the HECM's a little bit more creative. We call it the Swiss Army knife of retirement. You can get monthly income. You can get a line of credit that grows over the years. You can get part of your money up front, line of credit, monthly income, however you want to do it, whatever's smart enough for you, you can do it. The proprietary is basically a lump sum of money. You get it all. You can get all your money up front versus the HECM, where you can, if you're free and clear, you can only get 60% of the money up front. So sometimes when you have folks who do need money, let's say they're using their house to buy another house, kind of like a home equity loan without mortgage payments, they need all the money up front, then we're looking at a proprietary. Let's say that their house is worth over $1.1 million. They're looking at a proprietary because it's just going to give more money. And just so you know, the HECM's maximum home value is $1,089,300, whereas the proprietary can take home values all the way up to $8-9 million. So if you have a higher valued home or you need your cash out all at once, you're looking at the proprietary. If your house is worth, say, 1.2, 1.3 or less, and you want a line of credit or monthly income, or you need to be creative with it, then we're talking about the HECM. Okay, there we go. Now, this does say that reverses aren't very popular with retirees. In 2022, there was only 64,000 new reverse mortgages or new HECMs done. There were some proprietaries, but more HECMs are done than proprietaries. Here's the reason why. Whereas almost every senior who has ample equity in their home should look at using their home equity kind of all together, along with, again, their retirement accounts, their savings, their checking, their investment. Everything should be looked at to prolong retirement and to help you live as well as you possibly can in retirement. A lot of people don't. And the reason is there's so many misconceptions out there about reverse mortgages. So again, the misconceptions, they're for another video. But as this guy states, let's see here, talk about the risks. Okay, we'll talk about the risks in a second, but federal regulation of reverse mortgages has been tightened in recent years to reduce some of the risks. Basically, we don't loan money out to people who have demonstrated that they're financially irresponsible. We look at credit, we look at income, we look at past payment history. And if it's not working, then it's not working. But even if, let's say you have a lot of equity and you're back on your taxes, but you really want to make it right this time, in one way, we can actually do a reverse where we hold a escrow set aside for your property taxes and your homeowner's insurance for your entire life expectancy. It's really neat. And all these changes, it says kind of recent, but all these changes happened 8 years ago in 2015. Well, why don't we know about that? Why don't more people understand these changes? Well, it's because as an industry, we've done a terrible job of teaching the public, hey, this is what reverse mortgages really are. I try to do so on this channel, and everybody I speak with, I tell them the truth about what reverse mortgages are now, but I'm just one person. There's a lot of seniors out there who haven't seen my videos, who haven't seen my channel. And so there are untrue negative perceptions that persist. And that's why there aren't a ton of people who are doing them. However, I will say this, and this is just me, right? I'm just one person, but I'm getting about 5 calls a day from new people looking to do reverse mortgages. And unfortunately, a good number of those people can't get them because they don't have enough equity. And this is the other thing I'll teach you. And to this article's benefit, or not to its benefit, this article did a great job of explaining, and I'll go down here. When we qualify for a reverse mortgage, we're looking at home value, which everybody knows. Age, the older you are, the more you get, the younger you are, the less you get. But look at this. This author, our guy Mark, he actually stated that interest rates have something to do with how much money you can get. Hallelujah. I have never, ever seen an article about reverse mortgages that addresses interest rates. And if you've been with me for a while, you understand that interest rates have a lot to do with how much money you can get from a reverse. In fact, as home value, or not home values, as interest rates are higher, you get less money out of your home. And when interest rates drop again, I don't know, but God willing, sometime, somewhat soon, when rates drop, you're going to be able to get more out of your home again. All right. So where were we here? All right. So he doesn't love reverse mortgages. And yeah, a reverse mortgage isn't Powerball. It does have to be paid back when the senior passes. If you want to give all of, excuse me, if you want to give all of your equity to your kids for some strange reason and forego it for yourself, then you probably don't want to do a reverse. In a perfect world, perfect world, that doesn't exist. We would support the income needs of seniors through higher Social Security benefits and lower healthcare costs. That's not going to happen. So what are we left with? Doing the realistic thing. So let's talk deeper about this article. Now, this is something it's good to mention it, but this gets over dramatized. The big risk, the huge risk. See how dramatic I'm being? Big risk of reverse mortgages is foreclosures. When it's correct, reverse loans do not require monthly payments, but borrowers can default if they fail to make property and insurance payments or keep their homes in good repair. They keep their homes in good repair. There's no reverse mortgage police that are ever going to come out after you close your home. I guess if you live in an HOA or a condo and the roof blows off, you got to put it back on. But if you have a reverse mortgage, you are required to carry homeowners insurance. And if you're in a flood zone, you're required to carry flood insurance, just like a regular mortgage. And if the house is a disaster because of something, a hurricane, an earthquake, whatever it is, then homeowners insurance will normally pay for it. And if they don't, sue them. I did that and I won. That's a topic for a different video. So, why is this dramatic? Is it just reverse mortgages that will foreclose on you if you don't make property tax payments? Or is it everything? Think about it. You're a homeowner. Let's say you don't have a mortgage on your house. You don't have a mortgage on your house and you're free and clear and you don't pay your property taxes. What happens? Yes, I hope you're saying I'll get foreclosed eventually because the tax man will cometh. He'll say, give me my money. And if you don't give him the money, then the tax man will cometh with the sheriff. That's no good. If you have a regular mortgage and you don't make property tax payments, what happens? Oh, yeah. The tax man will cometh with the sheriff again. With a reverse, same thing. So there's been a lot of talk about reverses. Kind of the downside of reverses, people will say, who don't know about them will say, I heard somebody lost their house. I'm like, I bet I know why. They didn't pay their property taxes. That's it. Pay your property taxes. You're a responsible human being. I don't like paying my taxes. You don't like paying your taxes, but we have to because we own our home. It's like it's in the contract. You got to do it. So, again, this is dramatic, and I was dramatic about it. But yes, if you pay your property taxes, keep your house in fairly okay shape, and either one of you or your spouse keeps the house as their primary residence, you cannot lose your home. You are not in default. You will keep it for the rest of your life. In fact, with the reverse, you stay on the deed and you pass it to your kids when you pass away, if you want them to get it. All right, let's look at more stuff here. Both fixed rate and variable rate HECMs are available, but fixed rate loans are unusual, require that you take the entire allowed credit up front as the lump sum payment. Yes, and furthermore, he's absolutely correct. Furthermore, fixed rate loans, as I alluded to before, they're only going to give you 60% of the money you can get up front, and the rest disappears. You can't have a line of credit with a fixed rate reverse mortgage. You can't get monthly income. All you get is, so let's say it's the mortgage is, let's say it's a $200,000 qualification for you. So you're qualified for 200. With a fixed and a variable, you can get 120 up front, but with the variable, that rest of it, that $80,000 extra, I'm just subtracting 120 from 200, by the way. That's how I get the 80. That $80,000 extra stays in a line of credit. You can get it after a year. You can just leave it in that line of credit. With a fixed rate, you got to take the 120 and you don't get the 80. It stays with the lender. Well, it's not owed either, so the loan size is smaller, but you can't take the extra money. That is why, and the creativity of the variable rate is why people get the variable rate very, very frequently. All right, continuing. So that's pretty okay. More often, hecm is structured as a line of credit that you can use for any purpose. Pay off a mortgage, cover your living expenses, or pay for healthcare. We use this a lot for home healthcare. I actually use the proprietary reverse mortgage a decent amount for home healthcare if they need. If you look at your entire yearly expense, and you need to get all the money up front, not just 60%. So it is also possible to receive a preset annuity style payment stretch over your life or a certain amount of time in your home. So pretty good. Key things to know about reverses. All right, he gets this wrong. hecms. Oops, I clicked something. Let's go back here. Sorry about that. So, okay, so we got this wrong. hecms are only available for homeowners, or reverses are only available for homeowners 62 or older. Wrong, or partially right. hecms, the government reverse mortgage, that's only for homeowners 62 or older. The proprietary, you can be 55 and get it. Furthermore, with hecms, if you have a spouse who's underage, say you're 62 and your wife is 51, then you can get the hecm. Your wife would be what's called a non-borrowing spouse. And if she lives with you, if you pass away, she's okay. They're not going to foreclose. She can live in the house for the rest of her life or sell it, whatever she wants. So there are protections for non-borrowing spouses with the hecms. With a proprietary, there are no protections. So you want to be very careful if you have an underage spouse. And underage with a proprietary, again, is age 50 or under 55. All right, so pretty okay, 50% here. You don't have to make debt service payments as long as you live in your home, but because you continue to own your home, you do have to keep the home in good repair, and pay property taxes and insurance premiums. You must continue to occupy the home as your primary residence. 100%, good job. hecm loans are insured through the FHA, meaning that they are non-recourse, meaning that if you owe more than the house is worth, nothing happens and they won't come after your kids, all right? Even the proprietary loans, they are non-recourse. They're required to be. So if they go underwater, then the lender's got to deal with it. But again, by law, they can't chase after your kids for anything, and they can't ask you to leave or pay the loan back. As long as you live there, right? As long as you live there, keep the house up and continue to occupy the home as your primary residence. All right. Next, reverse mortgage cash is not taxed, okay? And it doesn't impact Social Security. Doesn't impact Medicare. This guy's absolutely right with this. Now, if you have Medicaid, though, you want to look. You probably want to talk to an elder law attorney because Medicaid, unless you do a reverse a certain way, and I'd always work with an attorney because I'm not one, but you have to do a reverse a certain way so that your Medicaid isn't benefited or impacted. Or you just take the money and say, you know what? I got enough money now. I don't need to have food stamps. I don't need to be on Medicaid. That's a good idea too. Here we go. Repay. So yeah, that's right. Missing something, but it's a short article. I don't expect it to have everything. Repayment of the hecm loan balance can be deferred until the last borrower or non-borrowing spouse dies, moves, or sells the house. Yep, exactly. Good to go there. And again, finally, this is what makes me smile when I see Mark Miller. Again, freelance writer, no idea who the heck he is, but he got this right. How much you can get depends on your age, your home value, and the interest rates. The higher rates, you can get less. The lower rates, you can get more. Wow, he even put that in parentheses. Good man. Good man. So, all in all, it's a flawed article. It's not perfect. But he did a good job. This guy, Mark, did a very good job in kind of breaking down reverses. I wish you would have spent a little bit more time breaking down how realistic selling your house is in this market and finding another place to live. I think that would help. I'm gonna put my website on here. But again, when you have Morningstar, when you have Forbes, when you have financial advisors and CFPs, they're calling me to talk about their clients who need to use their home equity. They were not allowed to do that a few years ago. These journals, these publications weren't publishing this stuff a couple of years ago, or they were just non-thought out articles with just baseless information. They used actually a bunch of the reverse mortgage myths. I'm going to put myself on here now, actually. Here we go. Cool. So now it's me. So they were not doing the program and the reverse mortgage programs, and they were not doing senior citizens who need a little help. They were not doing them justice. There were scare tactics out there, and I don't think it was intentional. I think these guys just didn't understand what they were talking about. And it's so refreshing to see finally these people, these advisors, these CPAs, these attorneys, these financial publications, they're really able to take a deeper look into reverses. And by the way, I'm not saying that they're right at any time or at every time. Absolutely not. But what I am saying is that almost every senior who has a decent amount of equity in their home needs to look at these, because in this economy, with this market right here, with inflation as high as it is, a lot of folks need help. And if you can use your home equity to live your retirement a little bit easier, a little bit more comfortable, then man, it's a blessing. I'll tell you this personally. It's a blessing to be able to help folks do that. And again, I'm just a guy. I'm a reverse mortgage originator. A reverse is just a tool. It's not magic. It has interest rates. It has fees. It's not perfect. It's not Powerball. But in so many cases, I've done this for folks, and they've come to me very stressed, and they were unsure of themselves, and they were afraid. And once they got the reverse done, although it wasn't perfect, again, sometimes it was, but in some cases, it might not have been enough money. They might not have been able to pay everything off. But from getting from where they were, even 75% of where they wanted to be, man, they call me, they thank me, they send me Christmas card. It's just so cool. It is so cool to have that little tool that you use change somebody's life. And I know that's dramatic when I say it changed their life, but in quite a few cases, this little tool really does change lives. So again, if you want to reach out, if you want to see if a reverse makes sense for you and if you can do it, my name again is Jason Eichmiller. I run this channel, helped over 460 seniors. You can reach me at the phone number below, or 888-309-9705. You can go to www.reversequotes.com, or you can email me at jason@keyhomelending.com. And that's all. That's it. Let me bring this over here on my screen. I hope you enjoyed this. I like it. I really enjoyed reading that article. I thought the guy did, for not being an expert, he did a damn good job. So kudos to you, Mark, whatever your last name is. You did great. All right. Feel free to reach out if you need me, and take care of yourself.